David Solyomi, The Falcon Method, a proven system for building passive income and wealth through stock investing. Welcome to a comprehensive summary of The Falcon Method, a proven system for building passive income and wealth through stock investing by David Solyomi. As you explore this summary, you'll learn how to navigate the complex world of asset types, focusing on Warren Buffett's preferred investment, productive assets, such as stocks. The summary will guide you through an intelligent, structured approach to evaluating companies, discussing the Falcon Method, which emphasizes a buy and hold strategy to build long-term wealth. The key highlights include focusing on dividend-paying companies, looking for bargains, and using advanced financial indicators to create a well-rounded portfolio.
Buffett's Guide to Investing. Learn Warren Buffett's investment secrets and strategies for building wealth that would last. Warren Buffett is a renowned investor who shared his investment approach in a letter to his shareholders in 2011. His investment philosophy revolves around three main categories of assets: currency-based investments, unproductive assets, and productive assets. Currency-based investments are the riskiest type of investments since these are tied to national currencies and are vulnerable to inflation. Bonds are the most common example of these types of investments. Essentially, bonds are a loan provided by an investor to a corporation or government. The issuer agrees to repay the bond with interest at a certain future date. The drawback of currency-based investments is that they rely on the national currency staying stable against inflation. If the currency fluctuates in value, the investor's profits will be affected. Unproductive assets are investments that will not generate income once purchased. Examples of these types of assets include commodities like gold, wheat, and oil. The value of these assets is determined by supply and demand in the market, and investors typically buy commodities in the hopes of selling them at a higher price in the future. However, they do not generate income, so investors must rely on the fluctuations of the market to earn a profit. Buffett's favorite category, productive assets, is the best option for building long-term wealth. Productive assets, such as a company or rental property, do not rely on national currencies and have the potential to generate a secondary income stream such as rent payments. The most profitable form of productive assets is company shares. Buying shares grants investors partial ownership in a company, meaning the shareholder is entitled to a portion of the company's profits, often paid out in the form of dividends. The shareholder also has the freedom to buy or sell their shares on the market at any time. In summary, Warren Buffett's investment philosophy recommends investing in productive assets over currency-based investments and unproductive assets. Productive assets provide the best opportunity to generate long-term wealth and income and offer more benefits than other types of assets. Sensible stock investing. The black box metaphor used by David Van Knapp simplifies investing by helping investors focus on examining what is visible about a company. The metaphor characterizes firms as black boxes with input and output pipes. Input pipes include revenue and equity sales, while output pipes cover ongoing expenses, debts, acquisitions, and taxes on profits. When scrutinizing a company, the most important output pipe to examine is its profits. Companies that focus on retaining earnings, payments to shareholders in the form of dividends, and share buybacks are often a great investment opportunity. The black box metaphor directs investors' attention toward the critical areas of what they can see. Falcon Method. Learn about an investment approach, the Falcon Method, that advocates for a buy and hold strategy with a focus on only investing in well-known, reputable companies. Have you ever dreamed of becoming a professional stock trader, living a luxurious lifestyle while making money on the fly? While that may sound appealing, the truth is that this kind of trading lifestyle is only profitable for a small percentage of investors. However, there's a different investment approach that anyone can employ, the Falcon Method. The Falcon Method is a variation of the classic quantum investing approach. Instead of ranking a set of stocks according to quantitative criteria and buying the best ones to hold for a period of time, the Falcon Method focuses on a buy and hold strategy. This means that investors should anticipate an increase in the stock's underlying value while receiving continuous dividend payouts before selling the asset for a profit. Unlike the classic quant method, the Falcon method only advocates for investing in reputable and well-known companies. This makes the investment process much easier, as it's hard, and often unwise, to commit your capital to a firm you don't know well. By removing human bias and emotion from the equation, this approach prevents costly mistakes and increases the chances of investing in above-average opportunities. Overall, the Falcon method is an investment strategy that anyone can utilize and benefit from. By embracing a buy-and-hold approach, focusing on reputable companies, and removing psychological bias, investors can increase their chances of success and profitability in the market. Falcon Method: Investing in reliable dividend-paying companies. The Falcon Method focuses on investing in companies that have been paying dividends for at least 20 years without reducing the amount paid during this time. Dividend payouts are a reliable indicator of a company's consistent earning power, as opposed to revenue and cash flow figures that can be manipulated. Firms with a long dividend history and no reductions to that dividend are the main focus of the Falcon Method. The method takes a flexible approach and concentrates on opportunities outside the S&P 500 index, understanding that it's better to channel resources into securing a firm's future rather than solely increasing its dividends. While a good dividend record is a positive sign, it doesn't always guarantee a great investment. Finding bargains in the stock market. In the era of online shopping, finding good bargains can be a real challenge. But with the right knowledge and strategies, investors can secure discounts on valuable companies and assets in the stock market. The key is to understand the difference between price and underlying value, and to take advantage of the market's emotional fluctuations. When the crowd panics, smart investors can strike by buying top-quality companies at discounted prices. However, this approach requires knowledge, bravery, and a willingness to go against the market trend. On the other hand, buying into hype at overinflated prices can lead to losses. Overall, the trick to finding bargains in the stock market is to focus on the long-term value of assets rather than the short-term whims of the market. Falcon Method Financial Indicators. The Falcon Method uses three main financial indicators to determine investment-worthy companies: dividend yield, free cash flow yield, and shareholder yield. These indicators help investors assess how much money a company sends back to its investors through a combination of dividends and share buybacks. To apply these indicators, minimum values for all three should be defined, and companies must pass all three filters to be deemed investment-worthy. The Falcon Method is a strategy for determining investment-worthy companies. This method uses three main financial indicators to assess a company's financial worth: dividend yield, free cash flow yield, and shareholder yield. To apply these indicators, minimum values for all three should be defined. However, it's important not to set these values too high, as it could make it challenging for companies to pass all three filters, even if they have moderate values. Dividend yield is determined by comparing the expected dividend yield of a company with its current stock price. If a share in Microsoft, for example, is expected to pay $1 while its current price is $10, then its dividend yield is 0.1 or 10%. Free cash flow yield measures the relationship between the free cash flow per share of a company and the current market price of a single share. Shareholder yield calculates how much money a company sends back to its investors through a combination of dividends and share buybacks. While applying these filters, it's important to ensure that companies pass all three indicators. If a company passes one, it still must pass the other two indicators to be deemed investment-worthy. By using the Falcon Method, investors can assess a company's financial stability and worth before investing. The Falcon Method, a multi-factor ranking system. The Falcon Method's fourth step employs a weighted multi-factor ranking system to identify and rank top stocks. It uses various factors and assigns them a weight to calculate the final score. An example of ranking two stocks based on dividend yield, free cash flow yield, and shareholder yield is provided in the book. The Falcon Method suggests using a modified version of the Chowder Rule to compare a stock's current dividend to its future growth potential. The Falcon Method recommends constructing multiple Chowder Rules with varying time frames, 1, 3, or 5 years, and using them as a factor in the weighted ranking to avoid missing important data. Maximizing Returns, a Stock Investing Guide. The Falcon Method, a stock investing guide, suggests using quantitative indicators for selecting the best investment opportunities. However, subjective judgment can also come in handy if used cautiously. The ROIC indicator can help investors monitor how efficiently the management of a firm uses its resources for profitable activities. Another vital aspect to consider is avoiding cyclical stocks as their prices fluctuate significantly, posing extra risks to investors. Although using qualitative judgment can be useful, it should be the ultimate tool when selecting stocks. The Falcon Method suggests using structured rules and leveraging financial indicators to reveal the best investment opportunities as it ensures an increased probability of obtaining steady and long-term growth. A buy and hold philosophy.
In summary, the Falcon Method presents a systematic approach to analyzing and selecting stocks that are most likely to generate passive income and long-term wealth. By focusing on productive assets, using the black box metaphor to evaluate companies, and applying the Falcon Method's rigorous filters to identify undervalued stocks, investors can make well-informed decisions. Ultimately, the book emphasizes a long-term buy and hold strategy, looking for opportunities to invest in well-known, dividend-paying companies that have strong financials and underlying growth potential. Finally, the guide highlights the importance of balancing quantitative metrics with qualitative judgment to make the most prudent choices in the pursuit of building a successful portfolio.